Well, hey, welcome. Happy Wednesday, everybody, to the first, hopefully, mini state of the mortgage markets. My name is Mike Tinlin. I'm a Vice President of Sales and Marketing with Classic Homes. I'm joined with Rich List. He's a Managing Director and Partner with PenTrust Mortgage. Unfortunately, the tech ages have impaired one of our contributors today, Stephanie Dombrowski, a Senior Loan Officer with Ent, from contributing, but we will try to get her scheduled up for the next broadcast and have her tune in with her expertise. So between myself, Rich, and Stephanie, we bring in excess of probably about 70 years experience in this industry. And kind of why we're here today and the reason why you've joined us, and thank you again, is we want to address just the kind of the state of the local market in terms of housing, as well as the mortgage industry. We know that the media outlets have done a great job of the doom and gloom, and prices are falling, the sky is falling, everything's negative, and I think you'll be enlightened by some of the information that we have to share with you today. So Kim, if we want to move forward on some slides, we're going to take a few minutes here. Again, we think that owning a home is a great opportunity to just create wealth. And it's important to note here that while I'm with Classic Homes, Rich List is one of our preferred partners. We aren't here just to try to sell you a classic home. And in fact, if you're out shopping for resale, if you're looking at another builder, what we're hoping you take from this 30-minute webinar today is just the fact that there's some really good indicators in our marketplace right now. We've got a strong economy, the job market's strong. We actually have price appreciation. There's very little inventory to choose from. So there's a lot of things that are suggesting that we will hit and bounce right back much faster than a lot of the other markets that the national media tends to just put all together in the same basket. So Kim, let's go ahead and move forward. One item that I just want to hit on, I'm going to take about 5 minutes, go over 2 slides that is going to address kind of a national level of home price appreciation on a historical basis, but then also our local resale housing market. The chart you're looking at right here is home price appreciation. This came from the Remodelers Trade Industry presentation that was done last year. If you look back in the last 46 years, there's only been 2 blips where housing prices have gone negative. So if you're in the market and you're thinking, God, what's pricing going to do? It's going to go negative. Now, it's very unlikely we're going to see what we saw the last 2 years, which was 17%, 18% year-over-year appreciation. That was unprecedented. Likely not going to see that for a long time. Looking at this chart, though, you can see it's very common for us to have 5%, 7%, 3%, 10% even. The market has shown that in a lot of cases, minus 1982, where we were just coming out of peak interest rates hitting 18.5, inflation being over 10%. There was a minor correction pricing there, and then the Great Recession that a lot of us have either worked through or lived through in 2007, 2008. We saw that delinquencies really contributed to short sales, foreclosures, many communities overbuilding inventory and having to heavily discount a lot of stuff to move it. That obviously equated to years and years over of some negative housing. But if you're looking and you're the typical home buyer that's going to live in a house for 7 to 10 years, this isn't our data. Again, this is national data. You can't go wrong by investing in a home, whether it's new, whether it's used. Your home will appreciate. Kim, let's go to the next slide and look at our actual micro market here, Colorado Springs. Okay, so what we're looking at here, this comes from Pikes Peak MLS. I know we've got some realtors on here as well as customers. So this is straight from our local market. There's a couple areas I want to really hone in on here. If you look at our new listings, so you see the 1,042, and then there's a red circle, we're sitting around 790. Those are the new listings that hit the market that are available for sale. Yes, it's down 24%. That's not necessarily a bad thing. What that tells you is there's not a whole lot of stuff coming on the market, so there's not a whole lot of choices. Okay, we're going to come back to that in a second, but moving down to kind of the green highlighted, the pending sales. This is a really good leading indicator that we're starting to turn a corner. 963 pending sales in January of 23. When you look at the line below that, the sold listings, that's 643, that's a lagging number. All right, they have to be pending before they can close. So if there were 643 sold houses or closed houses in January, that means those were November and December sales. If you look at the 1,075, that was last January. For us, January was a hypersonic month. It was one of our best in history. So when you look at it, we're only off 10% from January 22 to January 23 in the pending sales. That means those 963 pending January sales are going to be closing in February and March. And again, that's the good leading indicator that more stuff has been put under contract in January, not that far off from January last year. Moving a little bit further down, median sales price and average sales price. This is important to look at because a lot of the national, local news, there's been speculation of how much your price is going to go down. Is it 5%? Is it 20%? Is it 25%? Seems like everybody's got a different opinion, different economists, different financial institutions, Fannie, Freddie, all the big lending institutions. Well, what we're seeing here is our market year over year, the average sales price actually went up 4.5%. The biggest increase there, obviously we had some months in there. If you look to the left of it, there's kind of a bar chart that shows you the ups and downs of price appreciation. We went from December to January, we increased 7%. So again, year over year, 4.5% is very positive price appreciation. Moving down, percentage of list price received. Obviously in our supersonic market, 101.5% is what we were seeing. We saw multiple offers, escalators, meaning I'll pay more than up to. A lot of you guys I know that are on this probably lost out on one or numerous homes throughout the pandemic. Well, now we're getting back to a little bit more of a normative level. 98.3% is a fantastic rate. I'm sure the brokers would agree with that. If you're listing a house at 500,000 and you're getting 495, it's a win. But again, we're not seeing the huge price reductions yet. Days on market, we went from 14 days to 51. Yes, it's a 264% increase, and a lot of the outlets will just touch on that, but compared to what I think is more important. And when you look at historicals, 50, 60 days is kind of an equilibrium. If you have a house on the market for 1 to 2 months, that's not a bad thing. The Housing Affordability Index, I know Rich is going to talk about this a little bit in some of his Q&A session, but let's be real, it's been a roller coaster, right? Rates are up, rates are down, rates are up, rates are down. So what do we make of that? Well, that's why we're here today, to talk about some of the different products and some of the things that are actually out there that are creative, that can allow you some affordable solutions to get into home ownership. Our active listings, now this is another important piece. Again, it's up 110%. Be like, whoa, there's a lot of listings on the market, but compared to what? So post 2015, we've averaged somewhere in that 2,500 to 3,000 active listings on the market. Before 2015, we were 4,000 plus in an average year. So when you look at 1,400 houses on the market, that's a very small amount of houses to choose from. Now, when you look down at our month supply of inventory, that's how fast are those turning over. We're currently at 1.3 months. That means every 1.3 months, new houses are coming on the market. So that means if you're looking at a house and you don't make a decision on that home, that means this time in 6 weeks from now, that house is gone and it's fresh new inventory. So we went from about a half a month, we were counting inventory in weeks instead of months, to 1.3 months. A healthy, balanced market, most economists will say, is somewhere between 4 to 6 months of equilibrium. Okay, so hopefully that sets the stage. We have Kim Sandoval kind of working production on this webinar. If you guys have any questions to this data or as we move forward, type them into her. She'll keep a log on them, and then we're going to try to save about 5 minutes at the end of this for any Q&A that we might have. So moving forward, let's dive right into some of these questions. So first topic today is on mortgage rates. So Rich, you're our single panelist today because of our technical challenges. So I think a lot of our audience would agree that they've all watched this. Mortgage rates have more than doubled in the last year. And I know you're going to say, I don't have a crystal ball, Mike, but what should they expect to see long-term in a rate environment?
So the one thing that we know for certain at this point, Mike, is that interest rates follow inflation. If I lend you a $100 bill today at a 10% interest rate, I'm hoping that you're going to give me $110 back a year from now. That makes the transaction worthwhile, and that makes it worth it for me to be a lender and for you to be a borrower. What happens when we experience hyperinflation, as we've been in the last year or year and a half, is that $110 that I'm now receiving back from you is no longer worth what it was when I lent it to you. You were able to take advantage of the money today and buy a good or service, and you were able to pay me back with money that was less valuable. And so that's why we've seen this massive change in mortgage rates last year or so, is that as inflation goes up, everyone's looking to the feds to see what's going to happen next. I don't think, I don't have a crystal ball, and I don't know that anyone really knows at this point And, you know, as we were talking about before we started this webinar, we've even seen some quite a bit of fluctuation just in the last 3 or 4 days in the market. But there's a lot of indicators that show we're going to start to see inflation numbers start to wane in May and in June. And I think that, you know, we're being a little bit hopeful, but I think there's some strong indicators that are going to show it's going to be a really great mortgage rate here next.
So Rich, you broke up there just a little bit, and I'm sure everybody was thinking, did Rich say that we're going to get 3% interest rates again?
Yeah.
Because you seem to have lost your voice at the perfect time.
Okay, so I don't think I wanted to say a number, Mike, but a lot of the indicators are leading us to think that rates are going to be down pretty substantially from where they are presently. Now, substantially, I think in my mind would probably be low fives for a standard 30-year fixed rate. We've been vacillating over the last 12 months, kind of between the high fives and into the 7% ranges for a lot of buyers. So I think we're going to see them come down from that 6.5, 7 range, maybe to the lower 5.
So Rich, I saw statistics that said since 1971, the average mortgage rate has been 7.5%. Do you think we ever see threes again, in your opinion?
Well, if you think about it, we really only saw threes for that really short period of time under COVID and a couple little blips when we had some pretty crazy things happening in our economy and around the world. I don't think it's realistic to think that 3% rate is going to be out there anytime in the near future, barring another COVID-like catastrophe that affects all of us in so many different ways. Right. Money being that cheap, you know, in a lot of ways, you pointed out those numbers of you know, people couldn't buy a house, they were getting bid out by 5 or 6 different people. House prices were appreciating at such a high clip that appraisers couldn't keep up and buyers couldn't buy them. I don't think interest rates being 2-3% is really good long-term for the economy. Those of you on the call that maybe have a 3% 30-year fixed are probably thrilled about it. But in general, no, I don't think we're going to see those back.
Perfect. All right, Kim, let's move to the next question.
So this one here, this kind of shows what we were maybe just talking about. We can kind of go back to it. Go ahead, Mike. I'll let you read the question and we can jump.
I think that one's tied to this next one on recession. So, Rich, some say that we're headed for a recession, and others say by definition we're already in one. What do you think what does it mean to our housing and lending industries?
Well, myself personally, I think we're probably already in a recession. Gross GDP has been down 2 quarters in a row, which tells us by most indicators that we're in a recession already, and we probably have been for a few months. I think the media uses those types of words to drive fear into us, and I think they've done a really great job of keeping buyers on the sidelines. I think as I was driving around this weekend to some different model homes in neighborhoods that I feel like I was in just a month ago have a new apartment complex going up. I'm a strong believer that some of this news is disingenuous. Wall Street is funding these projects, not just in Colorado Springs, but all across the country. We're seeing hundreds of units going in. And I think to some degree, the media in Wall Street benefits when we rent homes. And so I think that's why we're seeing so many units go up around town. They're banking on most people not being able to kind of go out on a ledge a little bit and make that purchase and make that commitment to housing. And I know you and I agree on this, that the only way for the average, regular, middle-class person to really get ahead is probably to buy real estate and at least own your own home that you live in.
Yeah, no, that's a good point, because what is the, you know, a lot of guys are talking about the average rental interest rate is 100%, correct?
Right. Well, I was having a conversation with a friend of mine recently who's one of the groups that's putting up a lot of the apartment buildings that are going around in this around the Springs and in different places around the country. And I said, hey, cap rates have to be going down. This has to be trickier. Your lending costs are getting more expensive. And he said, yes, all that is true. But he said, the more people that are unwilling to buy homes, we're banking on that rental prices are going to keep increasing and increasing and increasing. And so, you know, your mortgage that you know, for your house that you bought 2 years ago, your payment hasn't changed, but the house value has gone up. If you were to rent your same house today, you'd be paying more than you're paying for the mortgage. You wouldn't be paying down principal. You wouldn't be getting a tax savings. You wouldn't be building wealth for your children, hopefully someday. So when we really think about it, there's really nothing besides a 30-year fixed rate mortgage that allows you to fix your expense. What we've all experienced over these last year or two is that the price of everything is going up with little to no control that we have. But my house payment hasn't, right? I'm still making that payment. And as long as I pay it on time, no one's ever going to bother me for it. And I think we discount that. And I think we discount what, what our rents were a year or 2 or 5 years ago versus what they are today. And because it incrementally sneaks up on us and we generally don't look at it.
Yeah, most definitely. I mean, we were seeing, I know you and I talked about a slide, and I'm sorry for the group, maybe we pull that into the next meeting, but 117% price appreciation on the homes that have been purchased and owned over the last, 25, 30 years. And I think you're right, the rental rate increase slips away from us, and we don't benchmark that as well as we do home price appreciation.
Well, I think last year we saw it was up 18% alone during that period. Hey, look who joined us. Hi, Stephanie.
Welcome, Stephanie Dombrowski, Senior Loan Officer with ENT. Stephanie, thanks for being with us. We're kind of in the middle of things. We'll loop you back in when we get to this next question. Rich, any other items to discuss on this current slide that we're looking at on inflation driving?
Well, I think the one point that I would really drive home to everyone who's listening is that recessionary periods are not bad for housing historically. And we don't have it on this chart. This just shows the last few somewhat mortgage rates. But if we go back and we look at the recessions that we've experienced over the last 100 years, which has been every 8 to 12 years, housing has performed very well in all but one of those scenarios. And generally when that happens, the supply of money gets tighter. People stop spending quite as much as we're starting to see today, but mortgage rates then follow and start to retract. And I think we're going to see that coming up in the coming months, where people are maybe a little unsure about what the market's going to do from a stock and equities perspective, and they're going to think, boy, I can put my money in something like real estate that's a lot more secure. And so if we look at almost every scenario, with the exception of our 2008 housing crash, that was really, highlighted with housing. Real estate's performed those recessions.
So we could all subscribe to date the rate, marry the house, right? A lot of us have heard that before. If we're assuming that, hey,
before, yeah.
But if you find a house that you fall in love with, don't let that house move on with another homeowner, right? Marry the house, date the rate, and always lock in your financing later.
Right. Well, and even to take that one step further, you might not be able to afford the house that you really want today, Mike. But if you don't get in the game, it's not going to get easier. I can promise you that. The house I live in now is not the house, wasn't my first house. And the first house I bought wasn't the house that I really wanted. It was the house I could have afforded then, right? Yeah. And I made several jumps and several changes to get into the home that I ultimately live in, right? So if you don't start, it's really hard to be in the game.
Wonderful. All right, let's keep moving. Next slide, please. So Stephanie, we're gonna bounce this next question to you. I think we're moving one more forward, please. All right, one more forward. Okay, let's talk about mortgage programs. And then Rich will give you a second take on this one. We've got about 5 more minutes before we want to get into Q&A here. So Stephanie, what are some mortgage programs that and you can offer to help people lower their monthly payments?
Well, thanks, and I'm sorry for joining late. We obviously, when we first start talking to buyers, budget is the biggest thing that we want to discuss with them. How much they want to spend monthly, how much can they spend monthly. We've got quite a few programs, I think, that helps. Our ARMs, which folks have been afraid of over the last 10 years, they came back with popularity the last year, and they're better than they were before because they're longer terms. We have a 5-year fixed and then a 7-year fixed. We can get you in a lower interest rate and also buy those down permanently for those first 5 years or the first 7 years. So there's that. The thing about the market a couple of years ago is the rates were lower, but for existing homes, the prices were higher. And for new homes, these incentives were not available, that, like they are now. So we've got some wiggle room to get the rate, permanently brought down. The other thing is really the long-term locks. We talked about earlier this year, we didn't think we would need them this year. And perhaps we're going back to people being interested in a long-term lock. If you know what your payment is when you write the contract and the maximum rate that you can get over the next 7 to 9 months, it's going to give you a lot better peace of mind while the house is being built, because you know the maximum rate that you're going to get. And with the float down at the end when the house is complete, if the rates do go down, you can get that lower rate. So I think that's been going to be a big help this year, even though we thought we might not need it. The other thing is really just debt consolidation. It's not all about your housing payment, it's taking a look at your whole financial picture. I can tell you what the rates are and what your payment's going to be and what the estimated tax and insurance is going to be, but if you're not comfortable with that, we can look at the whole picture. How much is your car payment? Do you have any other student loans that we can consolidate? Can we get the credit cards paid down or consolidate that? So if you can lower your debt, maybe you can have more room in your housing payment for it to increase. We want you, no matter what is going to happen with rates the rest of the year, we want you to be comfortable with the payment that you're signing up for. Even if you're not marrying that rate, I want you to be, dating it comfortably, like, so.
Considering marriage.
Yes.
That's great. No, that's wonderful stuff. Rich, let's pass the same question over to you to talk about programs that PenTrust is offering.
Probably the one that we've had the most success with the most amount of buyers so far this year has been the temporary buy downs. There's 3-2-1 buy down, a 2-1 buy down that's the most popular, and a 1-1 buy down. And what that basically does with the incentives that Classic and some of the other sellers are offering in our marketplace right now, it allows you to have a short-term buy down in interest rate, but still have a fixed rate. And so Stephanie had mentioned sometimes an ARM is a great option for people, but there's a lot of fear around it, and I understand that. But with the temporary buy down, you can take advantage of a lower interest rate or a lower payment today, and then you can kind of ease into that long-term interest rate. Or if what a lot of people think happens and interest rates drop over the next couple of years, you could refinance after a couple of years. So a temporary buy down has been by far the most popular product that we've seen over the last couple of years. And it's important for buyers to remember there's really, like with Classic Homes right now, that incentive will pay for them. And so there's no cost and there's no fear to getting into it.
So it sounds like between the different programs you guys have, it really makes sense if somebody is in the marketplace shopping, if they're even considering it. There's a lot more than just when you pick up your Zillow app and you punch in a purchase price number on what that looks like. There's so many more programs and options to look at their entire financial picture to see if they can really afford the home that they're interested in.
Most likely, yes. Yeah.
Wonderful. Okay. So we are sitting at 5 minutes till 12:30. Kim, do we have any questions from any of the registrants at this point?
Mike, I don't see any questions right now, but it looks like a couple of people are typing. So I think if you want to jump into the top 5 tips, maybe we'll give them a chance to type out their questions, and we can do that right at the end.
Yeah, please do, everybody. If you're compelled to ask a question or two, please do type them up. We want to hold you guys to the 12 to 12:30 timeframe that we promised you. If you need us to stay on for another 10-15 minutes to address a couple questions, we are here to support that. So let's move forward into the fourth question of our panelists today is, guys, what are the top 5 mortgage and financing tips for people who are either in the process of building new or considering an existing home?
I'll go with this, Mike. I think the first thing, and then maybe we'll let Stephanie talk about the next few, but you have to be transparent and honest, with your lender. Banks and lenders want to lend you the money at the end of the day. And so the biggest thing that I find when we have trouble or if something comes up is generally the buyer wasn't completely forthright. And I don't think they necessarily lied or anything like that, but just be transparent. And a good loan officer is going to take that information and then package it appropriately. I think when you're working with the right lender, They want to finance your house. They want to get you into the right loan. And if you tell them all of the challenges up front, it's going to be a lot easier for them to help you.
That's great. Thanks, Rich.
Yeah, really, when you're talking to a loan officer, there's things to get together. I mean, obviously, as I mentioned earlier, I want you to understand what your budget is, and I want to help you with that budget. But once you have everything worked out and we talk about your payment, get together your documents. I'm going to tell you exactly what you need. The loan officers are going to tell you exactly what you need to get them to us fast. We want to get you pre-approved as fast as we can. We want to get you comfortable with the payment as fast as we can. And we want to let the seller know that you're ready to go as fast as we can. Think about your sources of down payment. If you're struggling to figure out where those are coming from, we can help you find different options like 401k or things that you might not have thought about. Employment status. A lot of times if you're changing jobs, especially with a new build, if this is a 6-7 month process, you might change jobs during that time. Let us know, reach out before you do. We'll definitely communicate with you if it's not a big deal or if it is a big deal. And then obviously no large financed purchases, especially cars. Buy the car for the new driveway after you close. And, we always send out all these sorts of tips as soon as you're pre-approved, because a lot can happen over the time. If you're doing anything, just reach out to your loan officer and let them know what you're doing and just get advice if it's okay.
Great. Thank you, guys. Those are they seem like basic tips, but they're ones that can sneak up on you. So appreciate your expertise on that. Okay, we are a minute till. So all of you that have joined us today, we want to thank you. For starters, you will receive a recorded copy of this. You're also going to get an exit poll survey that Kim will be sending out. We would love to hear from you. If there's other topics that you think you or friends or family or colleagues would benefit from, we want to know if there's value in proceeding with more of these moving forward. And we want to know what kind of content you would like to benefit from. We're willing to cater this to you, keep it short and sweet. If there's other, items that we really need to focus in on, we're happy to do so. But again, want to thank you. And Kim, if we don't have any questions, I think we can probably disconnect for the day.
We actually now have some questions. So
okay, well,
we had quite the audience that typed in questions. So I'm going to read them out and then address them to the appropriate person. The first one is for Ent, and the question is, how does the Ent Jumbo 5-year, 6-month ARM work, and what about the 30-year term?
Our jumbo 5-year ARM, basically, for the first 5 years, that rate is fixed. The 5-6 is our lowest ARM rate that we have, and so what happens after the 5 years is every 6 months that interest rate can change. Obviously the goal, if you're doing an ARM, is to watch the rates during that first 5-year period to see if you can get advice from a loan officer on the best appropriate way to refinance. But most people, if they're going to do an ARM, would refinance in the first 5 years. So, but the repayment, the adjustable, does change after 6 months. And then the fixed rate is obviously just fixed for 30 years. We have 15-year terms or 20-year terms.
great.
Okay, thank you. The second one is for Rich. Rich, is it possible to get a temporary buy down on existing homes?
Absolutely. Yeah, you definitely can do that. And we've seen that in many scenarios where we're helping our agent partners negotiate those into purchase contracts. So temporary buy downs need to be paid by the seller. So it can happen as long as there's enough seller concessions and the deal is negotiated correctly.
Okay, thank you. Stephanie, this one goes back to you. What is the current rate on a 5-year ARM?
Goodness. I didn't have my rate sheet up. I'm sorry. Can we come back to that one?
We can come back to that while you're looking it up. We've got a few more questions. So the next question is, what is considered a good rate for getting a decent interest rate and loan approval?
FICO score?
It's just, I think they mean FICO score. What is a good credit score?
What is a good credit score? So it varies. Every 20 points in credit score generally puts you into a different tier. The highest of which is generally 760. But depending on the loan type, if you're doing a VA loan, you're going to get really great terms. If you're at a 660 for a conforming loan or a jumbo product, you're going to want to be able to better price.
Rich, could you restate that last? You said jumbo or conforming, you would want to be above, and then you cut out.
Yeah, generally you want to be above 720 for better, for
Great.
conforming and jumbo products.
Okay.
That doesn't mean they're not available. It just means the pricing might be a little.
I found our rate for the 5-year ARM, it's 5.75. So typically with the buy down, we can get that down to 5.375. And so that would be fixed for the first 5 years.
Great.
Okay, and then it looks like we've got one last question that just came in. And I think this one can really go to any of the 3 panelists. And the question is, if I am considering renting instead of owning, what would you find the most compelling reason to own versus renting? It's a tough one, huh?
That's, I
Go ahead,
think
Mike.
we answer that one all the time. I mean, so, you know, when you are renting, somebody else owns that home and you are paying the equity that they are building in that house. When you're owning, you have an asset, you have a bank account that not only, if we go back to the second slide that we shared on the price appreciation, as that asset grows, your wealth in that asset grows as well. So yeah, I think Kim's pulling that up. So even if you could run some simple math and say you had a $500,000 house, and if you saw 5% appreciation year over year, that's 25,000. And obviously that's going to compound. And next thing you know, in 5 years, that house is worth $630,000. Whereas if you rent, your rent will continue to increase year over year as landlords' costs increase, and they want to make more margin on those. You will be continuing to pay more and more to rent, and unfortunately not have any sort of asset that you could sell or pull money from to take vacations, buy stuff, buy other properties, big life expenditures.
The other thing, kind of to piggyback on that, Kim, I talked to a lot of people saying, well, housing isn't going to continue to appreciate at the same clip that it has. And that very well might be true. I'm better off investing my money in Apple stock, right? And that might very well return as a percentage a larger amount. But if I want to go buy an Apple stock, I have to have the cash to do that, right? Whereas if I want to purchase a home, the bank's going to give me, in some cases, 100% of that money for me to take advantage of that equity position. There's no other asset that you're able to borrow that appreciates in value the way real estate has historically.
Yeah, and even on your Apple stock comment, Rich, it's really nice to look at it and say, I wish I would have bought it when it was at $74 a share, right?
Yeah, that would have been the right way to go.
But if you want to buy stock, you got to get in the game. And the same goes for the housing industry. We can look back at prices 4 years ago and wish we would have bought. And again, this is for resale, it's for other builders, it's for classic homes. It's one of those things that if you're considering it, it's never going to be a poor investment if you're willing to hold it, but you have to make a decision to get into the game at some point. Any other questions, Kim?
Yes, we actually had 2 more come in. So if you guys are okay taking.
We'll keep it going.
All right. So this question is, can you get an ARM on a VA loan?
Ent doesn't offer ARMs on VA loans. I don't know if PenTrust does. We shied away from them just because people hadn't been doing them. The nice thing about the VA loan, even if you can get into a fixed rate now and buy it down as low as you can, the streamlined refinances on VAs are so great. If that happens the next couple of years, if rates go down, it's really easy process to refinance.
So the simple answer, Kim, is yes, but to follow up with what Stephanie said, right now, for the most part, and it's my experience that they're not advantageous. And so some lenders are offering that product. At PenTrust, we're technically offering it, but the pricing just isn't very good. And so So yeah, it's available, but not generally one that's advantageous.
Okay, thank you. And this appears to be our last one. How much does the 5-year buy down cost?
The 5-year buy down. So maybe the question is regarding a temporary buy down. Maybe a 2-1 buy down is the one thing that we mentioned. If that's the question, then generally, if the rate was a 6% fixed, then the 2-1 buy down would go 4%, 5%, 6%. And so the difference of those years is how much the buy down costs. Generally speaking, it's about 2% of the purchase price for the cost of that buy down. The great thing about that temporary buy down is if you were to refinance or pay off your loan halfway through that term, whatever amount of money that you didn't use in that bank account gets refunded back to you. So that's what I mean when the seller is willing to contribute that for you as a buyer, there's really no risk.
Okay, I think that you've answered the question. I think what they may have been referring to is the 3-2-1. And so I think you've addressed that.
Okay, great.
And oh, there's one more, you guys. They just keep coming. I think they're all sparking different questions as you're answering them.
That's wonderful.
For the ARM, if the rate goes from 5.75 down to 5.35 with ENT, is that the same across the board? So I think the question there might be is what happens after the 5.3?
Okay. And I was wondering if that question before that was how much does the buy down cost on that 5-year ARM? So I'll just answer it just in case. That's about 1%. So if you're going from 5.75 to 5.375, it's about 1% of the loan amount. So $6,750 on a $600,000 loan. If you buy it down to that 5.375, that rate is good for 5 years. And then after the 5 years, it can adjust every 6 months. So it can go up 2 points every 6 months. So obviously the hope is you get into a fixed rate before that. You know, there's been many times when people are getting into ARMs that the rates actually do go down after the 5-year period, but I think buyers are not really typically willing to wait and see if that's their luck.
Thank you. And Mike, with that, I believe the questions have stopped coming in. So I think we are ready to conclude. But again, should you have any questions, go to classichomes.com/webinar questions. And we've got a form set up there for everybody where you can submit your question and we will pass it along to either the appropriate lender or a member of our team and answer those questions. And those questions can be anything from mortgage related questions to the housing market to any type of inventory that's available, but we are here to help you.
Well, big thanks to our attendees that took the time out of your busy day. We know you guys all have a lot of things going, and so we thank you for that time. Rich, Stephanie, thank you for your level of expertise and contributions today. Be on the lookout for future event dates for us. We'd love to carry this forward. Again, we'd love to hear from you on what kind of content you'd like to hear from. And with that, we will say farewell, and until next time, thank you again, everybody.
Thanks. Have a great day.
Bye.